Okay, guys. So thank you very much for joining in for the AFM live revision session. We are going to be conducting these sessions over a period of next 6 days. In fact, it's going to be alternate day. So there are going to be 6 sessions that I've actually planned as a minimum. We would be doing these 6 sessions, and we would be covering all the core areas of the syllabus. The topic that I actually have chosen for today is the advanced investment appraisal. And the approach that I'm going to be adapting in order to do the examination question is going to be the examination questions. So what I have planned is that for the first 2 days, I would cover up the advanced investment appraisal questions. Then I would dedicate one of the sessions for mergers and acquisitions, one for the restructuring and reconstruction, one for currency risk management, and one for interest rate risk management. Now, what I've actually planned is I will do the latest December 2023 exam paper. I would come in the reverse order and I would try to do the questions in the reverse order. That's what I would try to do. So I will start off and I will start off. I will start off and basically, as I mentioned, that I would be going about with the December 2023 examination paper. That's the first paper that I'm going to refer to. So it's like December 2023 exam paper. I've got the AFM past practice and exam paper, December 2023. So I've just opened the December 2023 examination paper. Um, okay, so I think that every one of you knows that the examination actually comprises of 3 questions, with 2 questions from section B and 1 question from section A. So the question that I'm actually going to start off today is from the section A of the paper. And this was one of the questions that actually tested the area of investment appraisal in December 2023. So let's start off and let's start discussing this. The name of the question is McKeever Company. The name of the question is McKeever Company. And with respect to this McKeever Company, the examiner, what he did was, there were basically two different type of examination papers that were published. Just a second. There were two different type of examination paper that were published. So one of them had investment appraisal and the other question had the restructuring. That was what was examined. Now what I'm actually going to do is I'm going to start discussing this question and I would take you people through that how would you handle this in the real life examination scenario. See, it says the following exhibits available on the left hand side of the screen provide information relevant to the question, and the information that has been provided is what the McKeever company, the project information, alternate exchange rate assumption, the country risk. Then it says the answer should be used to answer the question requirement within your chosen response option. So let's actually go about discussing the requirements of the question, that what are the requirements of the questions. So it says prepare a report for the board of directors of McKeever company. So you have to do, what do you have to do? You have to prepare a report for the directors of the McKeever company, which estimates the project errors based cash flows in pound sterling. So you have to do the cash flow estimations in pound sterling. Estimates the net present value of the project in dollars. Then you have to estimate the project's net present value in dollars. Then it says evaluate the impact of the marketing director's alternative exchange rate assumption on the project's NPV, recommending whether or not the project should be accepted or not. Then it talks about discusses the assumptions made in the NPV calculations and responds to the marketing director's concern about methodology used to estimate expected exchange rates. Discuss political risk the board should consider. Discuss validity of chief executive officer's suggestion to adjust the project's discount rate to incorporate country risk. So these are multiple requirements that we have in here. And what we are going to do is that we're going to talk about each one of them. Yes, you'll be getting the recordings. Don't worry about it. You'll be getting the recordings. Now, let's just start off. So if I start off and start discussing about this MacKeever company, in case of any relevant information, any important information, I would just try to make sure that I put it down on the word processor or I put it down on the spreadsheet or wheresoever I want to put it. Now it says MacKeever specializes in the design and production of scientific instruments. So what does it do? The MacKeever company, it is basically specializing in the design and production of scientific instruments. Now it says, until now, the company has never sold or manufactured outside its home market. So it's like it has been operating in its home country only, and it has not sold anything or has not manufactured anything outside its home market, the United States. But chief executive has identified a new growth opportunity in the country of Iraq. So there's a country in which they have identified market. Although Iraq is an emerging market which has experienced extreme economic challenges in recent decades, the new government has introduced a series of incentives to promote inward foreign investment. So what is happening is that the new government has actually introduced a series of incentives to promote the foreign investment. These incentives were introduced after the recent election and were an important factor behind the CEO's proposal. So the simple thing is that you don't have the experience of going outside your home country, and this is the first time that you'll be going outside your home country. Now, what's the project information which is given to us? Let's just go through it. Okay, it says the country's currency is the Iranian pound, and today's exchange rate is 3.31 Iranian pound per dollar. So that means you need 3.31 pounds to buy a dollar. It has assumed that the project will last for 4 years. So what is it? The project will last for 4 years. Operating cash flows, the number of scientific instruments expected to be sold each year is as follows. So he has given to you the sales units. Now, the selling price is going to be 275 per unit in year one. So what's the selling price going to be? It's going to be 275 per unit in year one, incurring estimated variable cost of 100 per unit. So the variable cost is going to be 100 pound per unit. Selling price and variable costs are expected to increase in line with the annual rate of inflation in Iraq. So it's actually going to be Iraq's annual rate of inflation by which the selling price and the variable costs are expected to increase. Variable cost estimated in year one already includes the cost of the component, which will be manufactured in the US. So there is a component which is going to be manufactured in the US. So that cost is also included in the cost, the variable cost which is given. This component will be charged at a transfer price of 20 per unit, generating a pre-tax contribution of 10 pound per unit. Both the transfer price and the pre-tax contribution are expected to increase in line with the annual rate of inflation in Iraq. The project will incur fixed cost of this, increasing at an annual rate of this. Then what else is there? So it has actually given you almost all the information in the pound sterlings. So not much of a complication for the time being. But let's see. It says the investment costs includes 32 million for land and buildings, 18 million for plant and machinery. Tax allowable depreciation is available at an annual rate of 25% on the cost of plant and machinery on a straight line basis, with the first allowance claimed in year one. So the first allowance would be claimed in the year one. Then what it says, as an incentive to foreign investors, government has agreed to act as a buyer of last resort. So this is actually the option. This is the option to dispose of. In the event another buyer cannot be found for the land and buildings at the end of year four, Cost of land and building is therefore expected to be recovered in full at the end of the project, but expenditure is not expected to be recovered for the plant and machine. As another incentive to foreign investors, the government has agreed to reduce corporation tax rate, which is normally 30%. The company will pay tax rate at 20% in Iraq compared to 25% in the US. So you know this thing, when the profits or the remittances are transferred to the home country, so there is a differential rate of tax that is available. In both countries, the taxes are payable in the year the liability arises. A bilateral tax treaty exists. So whenever a bilateral tax treaty exists, that means that whatever tax you have paid in this country would be adjusted in the other country. The project will also require an investment in working capital at the start of each year, equivalent to 15% of that year's contribution. Assume working capital is fully recoverable at the end of year 4. Expected inflation rates in both countries are this. In the first instance, the board set asks you to appraise the new project using purchasing power parity model to forecast the exchange rates. The further information, Iranian government has removed all restrictions on dividend remittances. The board plans to extract positive annual cash flows at the earliest opportunity. McKeever normally uses 14% cost of capital to appraise the new projects. Now, what was the requirement of the question? The requirement of the question was you have to estimate the project's cash flows in pounds. Okay, McKeever company estimation of the cash flows for investment in Iraq. Now, what actually happens is that okay, now see what happens is that let's just see. The first thing is that okay, I'm just gonna adjust the size of this so that I could easily use this information also. Now it says time period 0, 1, 2, 3, and 4. So what is actually going to happen is that the selling price, the variable cost, contribution per unit, number of units, total contribution, fixed cost. Okay, in fact, what I would just do is that I would just show the depreciation also. Fixed cost, depreciation, profit before tax, taxation. Then the depreciation needs to be added back again. Working capital, land and building, plant and machinery. So what have I done? I've actually created a pro forma so that it makes things easy for me to go about as I want to go about now. And I think that I hope that it is visible to all of you also. I'll just zoom in the screen a bit. I think one more time. Okay. 110% is good enough. So we have got what? Selling price of 275 per unit in year 1, incurring estimated variable cost of 100 per unit. The selling price and variable costs are expected to increase in line with the annual rate of inflation in Iraq. So I am assuming that the selling prices do not include the inflation rate. So it's going to be 275 multiplied by the inflation in Iraq in year one is 1.05, right? And then the second year is also 1.05. The third year is into 1.04. The fourth year is also 4%. Then when we talk about the variable cost, the variable cost is what? 100. Multiply by 1.05. So we have got this. Now these are what the variable costs are. Now what next is there? You get the contribution per unit. So you get the contribution per unit. Then the number of units are 55,000, 67,000, 82,000, 90,000. The total contribution is going to be this into this. So this is what the total contribution is going to be. Then what do we have? We have a fixed cost, 750,000 into 1.05. So your fixed cost is going to be like this because there is going to be a compounding effect of inflation. Then the depreciation. Depreciation on plant and machinery is going to be available, right? 18 million is what the plant and machinery is. Uh, I need to actually see that this is the total contribution. Okay, so let me just put this in a proper number format. Okay, then what else do we have? The depreciation. So it's like 18 into 10 raised to power 6 divided by 4 because it's going to be straight line basis. So this is how it is going to be. Then you have got the profit before tax, which is going to be this plus this plus this. So the profit before tax is going to be like this. Then the taxation, which is going to be applicable at what rate? The taxation is going to be applicable at a rate of 20% because that's what the rate of tax is in your country. So it is going to be at 20% minus this into 20%. Got the taxation like this. Then the depreciation, which was deducted, is added up. Then we need to do the calculations for the working capital. For the working capital, you have got this time period, contribution, in fact, I could just make things easy by just copying because I need working capital for each of the year 1, 2, 3, and 4. Now, 15% of contribution. Okay, we mentioned required working capital. So it's gonna be 15% multiplied by the contribution, the incremental working capital, because you need to actually have the working capital's incremental effect. So it's going to be this amount, then this minus this, then this and this. So resultingly, what happens is that you would have to actually show that this is the working capital needed for this time period. So it's like gonna be this, this, and this, and in the end, the entire working capital is gonna be recovered. The land and buildings would be 32 million, 32 into 10 raised to power 6. And we expect the whole of it to be recovered. The plant and machinery, 18 into 10 raised to power 6. And then there is going to be 0 here. So cash flows for the year. Okay, so cash flows for the year is this. This is what we have as the cash flows for the year. Now what I'll do is that I'll just put in the relevant borders. Here, then here. Okay, so I've actually been able to put in the numbers in here. And I will just wait for a minute or two. Can you just look at it and can you just see that if you do understand all of this? Yeah, do you people understand this? Are there any questions in here? Okay, I'll just repeat the working capital calculation. Can you just see that the examiner says the project requires an investment in working capital at the start of each year equivalent to 15% of that year's contribution. Assume working capital is fully recoverable at the end of the year. Now, what is going to happen is that I've just created a working capital calculation. How? I multiplied this 15% with the contribution. 15%, 15%. Now, this is the working capital invested at year one. Then what will happen is that this working capital is the difference between working capital already invested and the working capital additionally invested. Right? Is that okay now? Okay, so we have got the cash flows for the year. That's what was required here. Now let's move a bit forward and let's discuss further. So one of the requirement of the question was, that you had to actually estimate the project's Iraq based cash flows in terms of pounds. I would just open the word processor. I know these are the requirement. The cash flows for the project in pounds are in the attached spreadsheet. Right? That was one of the requirements. Now there is this second requirement, estimate the net present value of the project in terms of dollars. So you have to estimate the net present value of the project in terms of dollars. Let's try to understand that how would we be able to do this? Which is that we have to actually estimate the net present value in terms of dollar. Let's just see that what is the relevant information. So we had the project information. We had the spot exchange rate. So we would just do the calculation on the basis of this. So this is gonna be appendix 1. Now I'll talk about appendix 2, and when I'll talk about the appendix 2, so first of all, I would say that exchange rate, forward exchange rate calculations using the purchasing power parity. So what do you need to do? You need to calculate the forward exchange rate using the purchasing power parity. The 1, 2, 3, 4. 0, 1, 2, 3, 4. The inflation US, inflation Iraq. So we had the information available. It was like 66775544. 6%, 6%, 7%, 7%, 5%, 5%, 4%, 4%, right? Right. So we have the inflations at different dates. Now, how do we calculate the forward rates? It's like currently it's 3.31 pound per dollar. Exchange rate is gonna be 3.31. It is pound per dollar. I'll just see if I can insert the symbol. Okay, so it's like 3.31. Now, if you want to calculate the forward exchange rate, what is the approach going to be? It is going to be 3.31 multiplied by 1 plus inflation in Iraq because it's pound, divide by 1 plus inflation in US because Iraq upon pound, the pound upon dollars. So this is how the exchange rate is going to be. I bet this is how the exchange rate is going to be. Right? Okay. Now, what do we see? We have got these different exchange rates and etc. So I think that there are few things that we need to consider. There was this some component also that was being transferred. The component will be charged at a contribute at a price of 20 per unit, generating a pre-tax contribution of this. Now let's just try to do this. Okay, I think I have made some error in the fixed cost because it mentioned that the fixed cost is expected to increase by 5%. I think I've made some error. I just connected the fixed cost with the inflation rate. 5% here, 5% here. Okay. But this also has to be 5%. And this also has to be 5%. Right? Okay. Now see what happens is that the cash flows in dollar, how would you calculate them? You would say these are the cash flows in terms of pound, divide them by the relevant exchange rate. So you get the cash flows in dollars, extra tax on profit at 5%. How would you have the extra tax? The extra tax is gonna be the profit into 5% divided by the relevant exchange rate, because you see there is going to be a 5% extra tax that needs to be paid. I'll just put the minus sign here. This is how it is going to be, the extra tax. Okay. Then what happens is that post tax contribution on internal transfer. How is that going to be? Just try to understand this. How is that going to be? So it's like we're earning the 10 pound of the contribution for the item that's being transferred from the US to Iraq. So it is like going to be 10, 10 the contribution multiply by 1 minus 0.25 because it has to be post tax, and then you got to divide it, then you got to multiply it with the number of units which is in here, and you got to divide the whole of it. I'll just do the calculation again. I'm incorporating it from year 1 equals to bracket open 10 multiply by bracket open 1 minus 0.25 multiply by number of units bracket close, then it is all divided by the exchange rate of this. So you get the post tax contribution on the internal transfer, right? So what happens is that post tax cash flows in dollars is gonna be this. Post tax cash flows in dollars is gonna be this. Net present value function. You would have to apply the net present value function. So when you would calculate the net present value, it is going to be the NPV PV. Okay, just in case if you get stuck somewhere in the examination, here's the formula sheet available also, which you could simply use for the spreadsheet functionality. That how to use the different formulas in the spreadsheet, you could simply use that. I will just repeat it, don't worry. Okay, so equals to NPV bracket open. What was the interest rate? That was 14%, so 0.14 comma all these values, and then plus this outflow. So resultingly 1463401 is the net present value. Now, okay, so whatsoever the questions that you have, I mean whatsoever the questions that you have, I will just try to answer each one of them. Now, uh, I will just move around slowly for the whole of the workings that I have done. I'll just move around slowly for whole of the workings that I've done. And whatever area you are struggling with, just let me know. I will guide you through in that area. So is everyone okay till here when we calculated the cash flows? Okay. Okay, how to decide inflation here? Because he's saying that the inflation would be applicable. So I'm assuming you can just write down in the assumption. You can just write down in the assumption. Okay, you did not get the plant and machinery. Okay, your PBT is wrong. Okay, plant and machinery. See, I talked about the depreciation. Basically, let me just explain. 18 million is plant and machinery. When you multiply anything by 10 by 6, it becomes million. So it's just a shortcut way of putting in the million. Let's say, for example, I put this 1 into 10 raised to power 6. It is 1 million. It is 1 million. So that's actually an easy or a shortcut way of putting in million. So that's why for the depreciation also I said that it's a 18 million divided by 4 because the life is 4 years. Then similarly, here also for the plant and machinery, 18 into 10 raised to power 6. 18 into 10 raised to power 6 is what it is, right? Okay, now what else is the query now? Okay, who else is stuck where? Any queries about the working capital? Fixed cost. Okay, let me just open the fixed cost. So this is what the fixed cost is. It's like 750,000 and it is increasing by 5%. In fact, what I'll just do is that I'll not increase it for the first year because we have removed the effect of inflation from it, and rather we have assumed that that the fixed cost is 750,000 for year one, and it would keep on increasing by 5%. Okay, what else? What else? Okay, cash flows and dollar calculations. Okay, let's just see. Yeah, first of all, we estimated the exchange rate. Do you understand how did I estimate the exchange rate? It is simply the 3.31 multiplied by 1 plus inflation in Iraq divided by 1 plus inflation in US. Okay, is that okay now? Okay, somebody wanted to know about the contribution. That how do you calculate post-tax contribution? So you are getting $10, sorry, 10 pounds per 10 pounds per unit. So it's like it's a pre-tax contribution. What I did was I multiplied this by 1 minus T because to make it post-tax, and then I multiplied it with C9, the number of units, divided by the exchange rate. Okay, let me just show you extra tax on profit calculation. See, what have I done? I have said that this is basically the profit before tax multiply 5% because the rate in your country is 25% in US. In the Iraq, it was 20%. So you have to pay 5% extra tax on that profit. Multiply by this divided by the exchange rate. Okay, lovely. Now let's just move a bit forward. So we have been able to do the second calculation also. That was basically the requirement was that we had to estimate the net present value of the project in terms of dollars. So this is appendix 1. The net present value in terms of dollars is estimated to be so and so as per appendix 2. So the net present value is estimated to be so and so in terms of dollar as per appendix 2. Right? Okay. Now let's talk about the third requirement. It says evaluates the impact of the marketing directors alternative exchange rate assumption on the project's NPV, recommending whether or not the project should be accepted or not. So this is the third requirement, which is evaluates the impact of the marketing director's alternative exchange rate assumption. Now, what is this alternative exchange rate assumption? Can you just go through it, please, quickly? Yeah, can you do the alternate exchange rate assumption? Okay, now let's see. It says the expected annual inflation rate predictions provided in the previous exhibit. were made after obtaining forecasts for both countries from a number of analysts. The analyst prediction varied widely over the period the board is planning to implement the new project, although there seems to be general consensus that the inflation is likely to increase in the US and decrease in Iraq. So they are expecting that the inflation is likely to increase in the US and decrease in Iraq, and that's what the inflation rates are. Finance director has managed the risk associated with these forecasts by attaching probabilities to each of the analyst predictions and then calculating the expected inflation rates provided. McKeever's marketing director has concerns about the lack of consistency across the range of analyst prediction and the methodology used by finance director to estimate the expected inflation rate. As an alternative approach, he has asked you to reassess the project using alternative exchange rate assumptions for the exchange rate based on the historical trend as follows. However, the finance director comments that the weakening of Iranian pound was suggested by less than 5% of the analyst prediction. Under this alternative exchange rate, an estimated present value of the post-tax component contribution has already been calculated as $485,000. Okay. Post-tax component contribution has already been calculated as this. So I'll just do this appendix 2. I'll just make it appendix 3. There are some things which are not going to change. Like, for example, this B19. So I'm just locking this cell, this C19. Similarly, D19, because I'll be just copying this whole. So I'm trying to make things easy for myself. Okay, extra tax on this profit is gonna be this. Right? Okay. So what I'll just do is that I'll just copy this whole. I'll just copy this whole here. I don't need these. I don't need these. So I'll just delete them. The exchange rate he has given is given it to be 3.37, 3.37, 3.41, 47. The cash flows in terms of dollar are based on these exchange rates. These exchange rates, the extra tax on profit is this. The profit on contribution separately needs to be removed. So the net present value for the function add NPV of contribution, which is already calculated, and that was 485,000. So hence the total NPV is gonna be this. So the combined NPV is 97002.139. So if we use the alternative exchange rate assumptions, the impact on the project's net present value is that it becomes it becomes negative 9700 instead of the positive NPV of NPV of 1490835. Based on this, the project should not be accepted. Right? So that is what you have to suggest to them. That is what you have to suggest to them. Okay. Now let's move a bit forward. You see how I actually attempted this? You see how I actually attempted this? I actually used the whole of the calculations that I've done till now. I did not do much of the calculation. That's a time saving technique that you should know. I did not use much of the, I did not do much of the calculation. Heller, this is December 2023, question number 1. The name of the question is McKeever Company. Okay. You want to see the NPV function? Okay, let me just open it up. Here you go. It's simply what happens is that you use the NPV bracket open, the rate was 14%, comma, all the values that you are using, then the bracket close plus the outflow, plus the outflow. That's how you do the NPV calculation. Right? Okay. So now what next is there? What's the next requirement of the question? It says, discusses the assumptions made in the NPV calculations in response to the marketing director's concerns about the methodology used to estimate the expected exchange rate and so and so, so and so. So you have to discuss the assumptions in the NPV calculation and respond to the marketing director's concerns about the methodology used to estimate the exchange rate in two. Now, if I talk about the assumptions that have been used, so always remember from the perspective of the examination, this is not a rocket science. This is something that is quite easy, which is like all that you have to do is that you have to just assume, you just have to think that whatever that you have done with the calculations, just try to put those things down. Like for example, like for example, one of the assumptions is starting from the top. One of the assumptions is that the units are there, the selling prices are there, the variable costs are there. Number of units, selling prices, variable cost, fixed cost will be is correctly estimated and is expected to prevail. That's one thing. The component which is imported from the US will continue to yield benefit, will continue to yield contribution of USD of $10 per unit. The component which is imported from the US will continue to yield contribution of $10 per unit. The tax incentive the tax incentive will continue to be applicable, and that the bilateral tax treaty will continue to exist between both the countries. Then what else is there? The entire working capital will be recovered at the end of the project, and the government of Iraq will honor its commitment of buying back the land. So what was the requirement? Discusses the assumptions made in the NPV calculation in response to the marketing director concerned about the methodology used to estimate the exchange rate. So what was his concern? Lack of consistency across the range of analyst prediction and the methodology used by finance director to estimate the expected inflation rates. Okay. With respect to the concerns raised by the marketing director about the with respect to the concerns which are raised by the marketing director about the lack of consistency with respect to the analyst prediction for the estimation of the exchange rates, the method suggested by the marketing director himself okay, working capital recovery at the end of the project. See, what happens is that just think about it. I am running a project for a period of 4 years. That means my money is tied up in the inventory, my money is tied up with the customers, etc. etc. What am I actually gonna do? I'm actually gonna make sure that when I close the business, I recover all the money from the customers. I actually sell all the inventories. That's what I would do. So the assumption is that the working capital is going to be recovered, right? So you would have to suggest with respect to the method suggest, okay, the estimations can always go wrong, but generally the estimations are the best estimations of the but generally the estimations are the best generally the estimates are the best possible estimations under the given circumstances, and I'm sorry, it's actually getting a bit stuck, so just give me a minute. It's actually getting a bit stuck, so I'm not able to write it down clearly. and the chances of the error are low. The chances of the error are low, right? So that was one of the requirement. Now there are two more requirement, which is discusses the political risk the board should consider before making a final decision, and discusses validity of chief executive officer's suggestion to adjust the project's discount rate to incorporate the country risk. How much marks are there? There are 5 marks about this political risk, plus there are 4 marks with respect to the country risk. I don't know how you are able to see this, but it's getting stuck a lot with me. I'm just switching off my video just to make sure that the bandwidth that is being consumed by the video is not consumed, and that we can have a slightly more smoother uh, smooth class to be taken place. There is a serious issue of internet going across our country right now, and that's causing a lot of problems everywhere. Are there any one of you who is having problems in accessing our web portal also? Is there anyone having problems in accessing our web portals too? Okay, I think the people who are from Pakistan, they're having an issue, but the people who are from outside Pakistan, they're not having the issue, because the service provider who is providing us the services for LMS, they've got their servers installed outside Pakistan. And what has actually happened is that the government is actually restricting the access to the international servers. Yes, it's purely a political risk. And I was talking to my service provider, and I said that what to do now. So he told me that we are actually trying to have another server based in Pakistan, so that people who are from Pakistan can easily access. I said that even we are unable to upload any recordings, I mean, like, even if we have to do something for the students on the portal, like, we keep on doing some things with respect to lectures and management and all that. So we are not even able to access our servers. So unfortunate, but anyways, not much could be done. This is the December 2023, Jamshed Khan. Okay. Let's just read through this country risk area also. I'm sorry that we had a bit of a disturbance. Can you just read through it, please? Can you just read through it? Okay, the boards express concern about country risk associated with an emerging market economy, the project's foreign exchange and political risk. For example, the main opposition party is challenging the tax incentives. Okay, uncertainty in the exchange rate, political party, the tax incentives may be withdrawn. I'm sorry, guys, it's just taking too long, basically. Okay, let's discuss again. Challenging which may be introduced and has overtaken governing party in opinion polls less than 6 months after last election. In theory, next election is more than 5 years away, but in practice, they have a history of more frequent changes in government. Okay, government can change before the full 5 years. New government would mean that new policies, the director's key concern is whether companies, shareholders, mainly institutional investors, will react favorably or not to the new project. CEO question whether project's discount rate should be increased even though project will not involve a change in company's capital structure or its normal course of business. Apart from being based in another country, according to CEO, this adjustment to the discount rate would reflect increase in the company's risk exposure due to both foreign exchange and the political risk. Now, see what happens is that what other political risks are gonna be here? The bilateral tax treaty may not prevail. The remittances may not be allowed. So there are several issues that you can face in here, right? Now, when we talk about the validity, risk adjusted WACC helps incorporate risk and uncertainty in the decision making. Increased country risk would increase the returns desired by the providers of finance. Yeah, what else? Okay. So risk adjusted WACC helps incorporate the risk and uncertainty in the decision making, and the increased country risk would increase the returns desired by the providers of finance. It will be appropriate to determine the WACC in which the adjusted rate of the providers of finance is incorporated, so that the calculations could reflect the risk appropriately. Okay. Is it okay? So we are actually done with this question, the name of which is McKeever Company. And this McKeever Company is the latest examination question from the ACCA December 2023 past papers. I'm sorry that there is a bit of a lagging in the video, because as I said earlier also, that we are having an internet issue. But let me know, do you understand this question? Do you understand the approach of doing the question? Yeah, do you understand the approach of doing the question? Did you see how I actually saved time by copying down a lot of workings and then connecting them with the formulas? Okay, I'll just go back to the Word document. Just a minute. Okay. Yeah, what do you need to see, please? That's okay, not an issue, Karen's husbands. Okay. So basically what I'm gonna do is that I'm gonna keep it till here. We're gonna join back again a day after tomorrow. So like it's every alternate day that we'll be having this AFM class up till the 2nd of March. And if I can get more time in between, I might actually conduct one the whole day session also. I've got a plan. I'm not confirming right now, but I would just try to do. So thank you very much, all of you, for joining in. Thank you for your time. Thank you for being here. It was great to have you here. Khaja Zakauddin, I would try to pick two of the questions on the investment appraisal, and I'm going in the reverse order. Like as I did December 23, I would try to see if there is a question in September 23, and then I would try to see if there is a question in the June 23. So I'm going in the reverse order. Helen, not an issue. It will just be available on the portal. Don't worry. I mean, we'll just try to make sure that we make it available on the portal. We're just having a bit of a technical issue. Because of that, we're not able to make it available, but we'll try our best to make it available as soon as possible. Jamshed Khan, yes, you probably can get answer on the ACCA site also. It's basically you have to go onto the paper, you have to go on to the last page of the paper, end the exam, and then exit. And then there is a self-marking option where you can get the answer. Right? Okay, thank you all. Thank you for your time. See you inshallah again.